Hi, I want to briefly recap because we are changing gears a little bit. And I spent a lot of time on diversification, but I now want to just kindly, quickly, not kindly, kindly too, recap a little bit. So we are risk averse, hold portfolios that are diversified, right? As a result, a project where, by the way, when I say project, I mean small, big, anything. The whole company is like a project too. Projects risk is largely what is common across assets. Why? Because everything unique to the project is gone. It's gotten diversified, not because of the manager. This is where it's very important to think of the manager, think like the investor. The investor is not worried about your project. If they were worried about your project, that would be exactly when all their money is in your project. That's not the case. They're worried about your project to the extent that's related to the market. And look at the beauty of this. How are all those relationships captured? RI, which in our case was Apple, alpha plus beta I, market plus epsilon I. I have replaced in the typical regression Y on the left hand side by RI, beta RM was X in the typical relationship. Now look what's cool about it. Let's measure this by S&P 500 and let's measure this by Apple. All I need to do is run a regression to pick up the sensitivity beta, and this is the measure of risk. The good news is, am I ignoring specific risk? No, it's in there. It's showing up here. But by definition, it's not related to the market. So that's why regression, I think, was created for finance. You know, it was just waiting for finance to happen. So the quick thing I want to move on to now is, given all this development, what does it mean? First, risk is defined, I told you. Defined, but also measured. How easy? How easily measured? Just a regression. I must emphasize though that as soon as you run just a regression, you have to worry about how many months of data, typically 60, that the animal you're trying to measure, in this case Apple, has not changed dramatically, still looks similar in the past to what your business is, which was orange, right? So things like that, and I'm not going to talk too much about that because that falls in the domain of statistics, but you have to do this intelligently. There are statistical biases you have to worry about and so on. So if I want to measure beta properly, you need to know statistics, okay? And I'm skipping that part and moving on to something that's extremely important, is how do I now use this risk measure to figure out what? I was interested in risk to figure out the return, because risk drives return, which then I will use to evaluate orange. And why Apple's return? For two reasons. One again, Apple is a comparable, and second, at this point we have seen that debt is equal to 0. So Apple's return on equity, which is in this regression, will also, the risk of this equation is telling me the risk of the equity of Apple, right? That will also determine the return on equity of Apple. But because there's no debt, RA and RE for Apple are the same. And I'm in business because I'm after RA. Okay, so let's see how do I develop that relationship. And this is the only time I'm just going to show you the relationship. And this is called capital asset pricing model. The reason for CAPM, the short form for CAPM, if you say that, everybody knows what it is. But it is capital asset pricing model. I want you to stare at this equation. What is this equation saying? That any return can be broken up into two parts. The first one is what? The risk-free return. As it turns out, it's not been defined here, so let me define it. This is the risk-free return. As you'll see in a second, do you know how to measure it? We talked about it right in the beginning. What kind of bond is considered risk-free? The government bond. When you're analyzing something that's living for a long time, like an idea, as opposed to daily trading, which people do, what kind of security will you look at? Long-term or short-term? Long-term, but which kind? Government bond. The second component is because of risk. But it has two parts. The first part is the average market risk premium. So what you want to figure out is how much does the market give over and above the risk-free rate. Remember the table we saw last week? In America, the rate of return on average over the last 70, 80 years, we in books tend to use about 7%. I'm very wary of this because remember, you're going to use this. There's a lot of data backing it, 80 years. But what did I tell you? One of the biggest questions is why has this been so high? So this is a little bit questionable but used very commonly. Many people do surveys of what it's likely to be in the future. If you put all data together, this has to be a lower number. And it's a very powerful number because even if you change it to say 5%, which some people propose, it has a dramatic impact because a 2% rate of return is a huge amount. So you start off with the risk-free rate, you add to it the risk premium on the market. But the risk premium on the market is not what your project is. What is the risk of your project? It's your beta relative to the market. So these two things multiplied together tells you the risk premium for Apple. So let me give you some, let's move on and get some intuition for this. Because I think this is probably the most used equation other than discounted value of the stock price is the discounted value of dividends. Look at this equation linearly. What is it showing? First of all, a graph where what is the risk-free asset here? Measured as a long-term treasury bond. And the reason, and the thing I like about it is very easy to measure, right? It's the one thing I know about the future is how much will a government bond pay. And why do I feel confident? Because I believe the government will pay. What is this? This is the risk premium, which I will say should be somewhere between 5 and 7%. And this is where it's very important to recognize which number you want to use here. And textbooks tend to use 7%. I believe it is a good idea to use 5% as well, at a minimum. Because remember, all the answers are not perfectly precise. And what is this? This is the risk of comparable equity. Why? It's almost always the risk of the equity. Why? Because equity trades, and even if there's debt in your business, most of the country's debt, in most countries, debt is a private contract between the company and a bank, so it doesn't trade. In America, you can get some information on debt as well. But typically, if you see a beta anywhere, and we'll see some soon, it's about the equity, because equity trades and easy to calculate. Now, here's this ironic, which is more difficult an instrument to think about. Debt or equity? Debt is a contract, simple to understand. Equity, love and fresh air. right? Very tough. But on the other hand, risk is easy to capture because of trading. Don't forget the importance of markets. Okay? So what does this say? That the return that is expected, and please recognize all R's in this are expected because it's about the future. You're going to use them from the past data, except for RF, because you know it about the future and you're sure the government will pay. Please remember, the expected is very important. You're trying to project to the future what may happen. That's why I gave you an emphasis on, don't use 7% for RM minus RF so easily, because it's questionable. Okay, so this is a graph, and let me just talk about the intuition right here, because this graph lends itself to the intuition very well. Okay, quick question. How many points do I need to draw a straight line? 2. So very easy to draw this straight line. Let me ask you this. What is the risk of the risk-free asset? Right? What's the risk of the risk-free asset? So RF, its beta F has to be 0 by definition. Why? Because a government bond, remember I told you what the risk was 0, simply because I believed I would get 1,000 regardless of the state of the world with the face value of 1,000. So BF is 0. So I pick up the treasury bill rate, suppose it's 4%. Tell me which point have I identified on the graph. 4%. I plot it here, and I know beta is 0. There's another guy whose beta I know. And what is that? The market itself. You see the intuition of CAPM is so important, so simple. Why? Because how does the market vary with itself? 1 on 1. So this is the beta of the market. So I have 2 points. One is this, and one is this. And I draw the straight line right through. You see how simple this is? And that's the simplicity I was talking about. One little equation. So let me ask you this. What should be the return on a risk-free asset? Suppose I found another project which I believed had no risk. Unlikely, but let's find it. What should its return be? Well, if its risk is 0, I plug in 0 here. This whole thing cancels. I'm left with the risk-free rate. Does that make sense? Absolute sense. Let me give you one more intuition. Let me ask you, what is the risk of a portfolio, or sorry, let's not talk about a portfolio. So what is the risk of a project whose riskiness is the same as the market? That is, the project moves 1 on 1 with the market, 1% up, 1% down, this. Its beta is what? Its beta turns out to be exactly 1, because that's the beta of the market. See what happens. The return on this should be the return on the market. Because what happens when you plug 1? RF and RF cancel. Isn't this cool? What is it saying? It's saying you can predict what's going to happen for 2 points, and they all both make sense. If your project is almost risk-free, your discount rate should be the risk-free rate. Think about this. If your project is bananas, your discount rate should reflect bananas. If your discount rate is oranges, you reflect oranges, right? Very intuitive, some intuition components. Okay, so I'm going to just quickly re-emphasize one. What are the components? Risk-free rate, measurable, beta F equals 0. Market return, measurable, not as well as RF, because RF is, we believe, is, yes, that's exactly what it is. Why not as perfect? Because maybe S&P 500 also doesn't pick up all the kind of possible investments, right? So it's kind of perfect, but not quite. Okay, but what is its beta B? Beta market has to be 1. Look how simple it is, right? But now let me ask you this. What is RM minus RF? That's the premium in the marketplace that you earn. Is this measurable? Sure. If the first two are measurable, I can go historically and look at the difference over 80 years or over earlier markets and so on. And this could be 7% or 5%, or many people believe maybe even less. And this is the biggest research area, one of the biggest research areas in finance is why is the risk premium been so high in the US? More importantly, will it be the same in the future? Okay? So we have more or less captured everything. And why is CAPM so powerful before we run into it? Based on a very intuitive and simple idea. And what is that? The intuitive and simple idea is that people are risk averse, they therefore hold portfolios. If they hold portfolios, the risk of one thing will depend on its relationship with a bunch of other things. That one thing in our case is Apple, because we are trying to evaluate Orange, comparable. And what is everything else? The whole marketplace. Simple measure of risk. Why? Because not only is the idea simple, the measure of risk is very simple. How do we measure it? We have done it in length. I'm just highlighting everything. We measure it by taking returns on Apple, a comparable for us, and running it a regression on markets. Can you measure those? Yeah. S&P 500 will do okay, just fine. Simple relationship between risk and return. I think this is even so. So the idea is simple, the measure of risk is simple, but the relationship between risk and return is just so simple and intuitive, and that is what we talked about in CAPM. It's linear and easy to measure. Very easy to measure. I mean, I'm getting a little carried away here, but I understand why. Because I can't think of anything that could have been simpler than that. And easily measurable, of course. Is it perfect? Answer is no. A lot of research has shown, not surprisingly, that not all assets fit this perfect relationship between when you measure the beta and you measure the return. The beta doesn't capture all the riskiness. And that's not surprising, is it? For example, if I told you you can measure love, would you find one simple linear relationship? If you did, there's something missing in life, right? But the awesomeness of this is conceptually it's so clean. And practically measuring is so clean too. But don't expect it to do wonders every time, okay? In a more detailed class, we measure different ways of measuring risk and return. But the profound, simple fact is this. If you hold a diversified portfolio, you should be looking at common elements across securities, not specific. And that basic idea carries through all future developments. I wanted to highlight that. Don't expect it to be perfect, but it's profoundly close to perfect. So let's take a break here. When we come back, I'm going to wrap it up with some fascinating data and in the context of valuing Orange and show you how simple it can be. Let's take a break.